How to escape a bad investment? That's the topic of our discussion in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me, as always, is the CEO of Value Research, Dhirendra Kumar. Dhirendra, we welcome you.
Thank you.
A very basic question to start with. How do you define a wrong or a bad investment?
First and foremost, it could be inappropriate. You are investing for the long run and you are being told something which is for the short run, or your investment is for a short period and you have been advised something which is meant for the long term. And then there could be the really toxic ones, one which hurts, and mostly, they fall in two categories. One is that too good to be true, the kind of rackets which people land into. And it's very easy to believe because somebody in the neighborhood will come and say that he made it, I made it, now you also, and you have missed it. And that
they kind of cajole you into...
Yeah, and you derive the comfort from the people whom you know. And that, the basic question is, too good to be true, it is unlikely to be true. So that's a thumb rule. The moment you get 15%, 18% assured return, you are unlikely to get your money back. Take a note of it. It always happens without fail. Then the other thing is, something which you landed, I came across a joke, that one person walked into a HDFC Bank branch with a gun and 2 lakh rupees in his hand and said that nobody should give me any ULIP, any of those things. I'm here just to deposit my money. So I'm just wondering that, there are active, aggressive salesmen. They have targets. They have incentive to do that. And that is generally, trying to meet their objectives. And they're not keen on understanding your needs, the appropriateness of the money, how critical that money is. Because inappropriate investment, and normally, if you ask the basic question, what is the risk, what is the return, what is the liquidity, and then any tax break that you get, any investment can be evaluated on these 4 things. If it is too risky, it should yield high return. And then, what is the liquidity? When can you get your money back? And is there any tax? What will be the treatment of the gains? What will be the treatment of any income in between? And will you get any tax? Will you get any tax break when you invest it? So you have variety of and every investment actually can be broken down into these 4 components.
Okay, mis-selling and poor advice is something that you have to be very careful of. The impact, Dhiren, of the wrong investment can be quite devastating. Why? Why is that?
Simply because you lose your trust for future. You stop, the moment you lose trust, then you stop trusting anyone. And then you get into assets which you think will also be inappropriate, but you'll be more comfortable. You end up buying house, you end up buying gold, that okay, nothing happens, it's lying in my locker. Nothing happens, I can see it. It gets me something. Nobody can run away with it. Nobody can fool me with this. So that also can be inappropriate because having financial investment which can beat inflation, which can beat fixed income return, can translate into something meaningful. The other assets, people have the sense that, the tangibility of it, real estate, as if everything else is unreal. But that's not the right thing. Financial investments have a purpose. They combine these 4 variables, liquidity, risk, return, and tax concession in a format which is more desirable and actually more suited for the modern life. You don't have to really worry about it. You don't have to worry about the tenant. You don't have to worry about the transaction costs are low. It's efficient. It's transparent. It's liquid. So those variables, I think, far outweigh. So that is one. You lose trust in the system and miss out on the big opportunity. And then I think, the other is that it's real loss. You invest your money, it's an opportunity loss. It's a real loss sometimes. You invest in an appropriate thing, it is disappointing. And many a times, it is not mis-selling, it is lying. Somebody will tell you something. So I think that is another check which everybody should ask, that people will say that this is what you will get, but it will never be mentioned in the paper. It will be never mentioned in the policy document. So asking those questions, looking for that evidence, looking for and creating a trail, but that is something, very difficult for a naive investor to ask those things when a fast talking salesman is after you.
So it's very important to read that fine print that comes to us. More often than not, we just ignore it. Yeah, just
It's so fine that it's unreadable. But you have to ask that, and I think the regulators need to do something here. The benefits and what you pay for should be in bold type. It's too fine to print, to read.
So how does one avoid getting trapped in these wrong investments? Are there any warning signals that we need to be careful of?
No, it's your money. You need to guard it and ask those 4 questions. What is the return? What is the risk? What is the liquidity? And is there any tax break? And if you don't get tangible answer, keep off. Don't be in a hurry to sign on the check.
Okay. And also recent past performances, what do you think of those? Should one look at them?
Those are usual, they are standard mistakes, but that is not actually a downright fraud. That is not something which lands into, because many times, it's very normal for people to chase what has happened in the recent past, belief in recency, something which has gone up by 30% in last 1 year. We extrapolate that, okay, if another run for 6 months, we'll still be making 15%. Chasing past performance, avoiding that, not being methodical, once again believing in something which is too good to be true, because even there it is too good to be true.
Okay. And what role does speculation play in all this?
Oh,
should one speculate?
It's a human instinct. Yeah. Everybody wants to, and easy money coming your way, and sometimes, and all in India it is a particularly very difficult thing, because all other forms of gambling is banned. It's illegal. So the only thing you are left with, this, and here is something where you speculate in the stock market and pretend to be doing some intellectual exercise. You are thinking about a company and you're weaving a story, or listening to a story, believing in that story, and then something else happens. But you don't know enough, and not knowing enough and putting your money is speculation, to my understanding.
Okay, and should one invest short-term money in equity?
Never. It takes time for companies to build, and it's very difficult to guess the stock market or individual stocks direction in the short term. So it's speculation, it's gambling.
And I've heard you say many times that you should always diversify. Would you like to elaborate on that?
No, those are basic, framework.
Just because you don't want to get trapped in a wrong, therefore I'm asking you this.
The thing is that, even if you are not speculating, even if you are investing, but things can go wrong. Businesses have inherent good, high quality business risks. Every business comes with a risk. It can work well, it may not work well, it can get into a cyclical downturn, and just having most of your money in one thing, you are more vulnerable. So spread your risk. And so if you have a lakh of rupees, spread it over 10 of them, all 10 of them will not actually fail. Be in good businesses, invest thoughtfully, be regular. So, these are all checks and balances. These are the operating framework which any investor should be doing. If you can't do all that, buy a mutual fund, do your SIP, that's it. Where everything else is taken care of.
Okay, now that you know what is a wrong investment or a bad investment, you also know what are the signals attached to it. The next question that I have, and I'm sure some of you would identify with it, is that if I'm already in a bad investment, what should I do? After listening to you.
No, that is actually the starting point, because most of the time people end up, they start with something which they did not plan for. So take a stock. It's never too late. Ideal thing is that, you should have checked all those things before getting started. If you haven't done that, take a stock, undo it. Don't lose your trust. Blame it on yourself. Or, it's better to be, taking stock, undoing things, winding up. Many a times, and, having a financial framework that you have your emergency fund, having your term plan, having your health insurance, and then getting started with your investments. Many a times people don't have that priority. All you do is, and, understandably so, you just have, too many needs at the outset when you're getting started with your career. You just don't have enough surplus. Then sometime in February, March, somebody turns up and say LIC खरीद लो, ये टैक्स का टैक्स बचेगा नहीं तो सारा टैक्स कट जाएगा. So you start less thoughtfully, and then you go. So whenever you are, if you are watching this, take a stock of things and start fixing it.
However, don't lose hope. Let it be a learning lesson.
No point of losing hope, because losing hope will not lead you anywhere. You have to plan for your retirement. You need to be financially independent. Then you have to do it. Whether you like it or not, whether you are financially oriented or not, but you have to do the basics.
The role of the fund manager.
Nobody has a choice as such.
Yeah, the role of the fund manager therein comes into play over here while you are looking at your bad investment, so to speak. If he's asking for too much of churn in your investment, should I doubt that?
There are different strategies. To my understanding, most good fund managers don't churn. They are just not active traders. They buy a company, hold it for a long time, and those stocks actually go up steadily, nicely over a period of time, and that translates into the growth. There are fund managers who have succeeded for a period of time, but I haven't seen a very sustained great performance from a fund manager with a high turnover ratio.